Right now, the average savings account in America pays 0.38%. Many big banks pay even less. On $10,000, that's about $38 a year, or less. Meanwhile, 3 of the safest places you can put your money are paying around 4%. On that same $10,000, that's roughly $400 a year. Same cash, same safety, 10 times the return. So the question isn't whether to move your money out of a near zero account, it's where to move it. And you've got 3 great options: high yield savings, CDs, and Treasury bills, each built for a different job. Today we break down all 3 head to head so you know exactly where your cash should live in 2026. Let's follow the money. I'm Don Blake, and this is USAFinance, where we hand you everything you need to get, keep, and grow your money, with nothing but sourced facts and plain English. This is education, not advice. We're not going to tell you which account to open. We're going to show you exactly how each one works, what it's best for, and let you match it to your own situation. The good news, all 3 options today are boring, simple, and about as safe as money gets. This isn't about risk or gambling. It's about not leaving free money on the table while your cash sits idle. Every rate comes from the FDIC, the US Treasury, and the major rate trackers. If this earns you a better return, subscribe. Let's get into it. First, let's be clear about the problem we're solving. The national average savings rate is about 0.38%, and it's barely moved all year. The biggest banks often pay less than that, as little as 0.01. Meanwhile, the best high-yield accounts, CDs, and Treasury bills are all paying somewhere around 4%. That's roughly 10 times the national average and hundreds of times what the giant banks pay. Here's what that gap costs you. On $25,000 of savings, the difference between the big bank and a 4% account is about $1,000 a year, every year, for 0 extra risk. That money isn't lazy, it's working hard, just not for you. Let's fix that. So where should that cash go? You have 3 excellent low-risk homes, and the whole game is matching the right one to the right job. Option 1, a high-yield savings account for money you might need at any moment. Option 2, a certificate of deposit or CD for money with a known deadline. Option 3, Treasury bills for maximum safety and a tax advantage most people miss. All 3 are paying around 4% right now. All 3 are extremely safe. The difference isn't really the rate, it's the trade-off between access, locking in that rate, and taxes. Let's take them one at a time, starting with the most flexible. First up, the high-yield savings account, the HYSA. Think of it as a normal savings account, except it actually pays you. It works exactly like the savings account you already know. Your money is available whenever you want it, you can move it in and out freely, and it's protected by federal deposit insurance up to $250,000 per person per bank. The only real difference is the rate. Instead of the 0.38% national average, the best online high-yield accounts pay around 4%, and they can afford to because they skip the expensive branches. So the HYSA is the easy upgrade. Same access, same safety as your current savings, roughly 10 times the interest. So what's the catch with a high-yield savings account? Honestly, there almost isn't one, but there is one trade-off to understand. The big advantage, total flexibility. Your money is completely liquid. You can withdraw it any day for any reason with no penalty. That makes it the perfect home for your emergency fund and any cash you might need soon. The one trade-off, the rate is variable. It can change at any time. If the Federal Reserve cuts interest rates, your 4% could drift down to 3 or lower automatically without warning. So a HYSA is ideal for money you need to keep flexible. But if you want to lock in today's rate and guarantee it, that's exactly what our next option does. Option 2, the certificate of deposit, the CD. A CD is a simple deal you make with a bank. You agree to leave a set amount of money untouched for a set period of time, and in exchange, the bank guarantees you a fixed rate. The terms usually range from a few months to 5 years. Right now, the best CDs are paying around 4 to 4.5%. And here's the key word, fixed. Whatever rate you lock in, you keep for the entire term, no matter what happens to interest rates. Like a savings account, CDs at a bank are federally insured up to $250,000. Your money is just as safe. It's simply parked for a while. So when is a CD the right move? And what's the catch? The big advantage is that locked-in rate. If you believe interest rates have peaked and might fall, which many expect, a CD lets you freeze today's 4+% for years. When savings rates drop, your CD keeps paying the higher rate you locked in. That's real protection. The trade-off is access. Your money is committed for the full term. Pull it out early, and you'll usually pay a penalty, often several months of interest. So a CD is perfect for money you know you won't need until a specific date, and a poor choice for your emergency fund. Lock in the rate, but only lock up money you can truly leave alone. Option 3 is the one most people overlook, and it might be the most powerful: Treasury bills, or T-bills. A Treasury bill is a short-term loan you make directly to the United States government. You buy it for a bit less than its face value, and when it matures, anywhere from a few weeks to a year later, the government pays you the full amount. The difference is your interest. Because they're backed by the full faith and credit of the U.S. government, T-bills are considered the safest investment on earth, even a notch above bank deposits. Right now, short-term T-bills yield around 3.5% to 4%. You buy them yourself for free at a government website called Treasury Direct, or through most brokerages. Now here's the T-bill superpower. The reason savvy savers love them, and almost nobody talks about it: taxes. The interest you earn on Treasury bills is completely exempt from state and local income tax. You still pay federal tax on it, but not a dime to your state. For someone in a high-tax state like California or New York, that changes the math entirely. A T-bill paying 3.8% with no state tax can actually beat a high-yield savings account paying 4% that gets taxed by your state. It's called the tax equivalent yield, and it's the quiet edge that makes T-bills especially attractive if you live somewhere with a high state income tax. Always compare after taxes, not before. So let's put T-bills in perspective: the good and the trade-offs. The advantages are hard to beat. The highest level of safety there is, that valuable state tax exemption and flexible short terms, so you're never locked in for long. You can even set them to roll over automatically. The trade-offs are minor but real. Buying them takes a few more minutes to set up than clicking a button at your bank. And while you can sell a T-bill before it matures, you'd get whatever the market will pay that day, which could be slightly more or less than you paid. For safe short-term cash, especially in a taxable account in a high-tax state, T-bills are a quietly brilliant option. So why are all three of these paying around 4% right now? One reason: the Federal Reserve. The Fed sets a key interest rate that ripples through everything. Savings accounts, CDs, and Treasury yields all move roughly with it. After a long stretch of increases, the Fed's rate is currently sitting in the mid-3 to high 3% range, and it's been holding steady. Here's why that matters for you. If the Fed holds or cuts from here, these 4% yields may not last forever. That's the argument for locking in today's rate with a CD or a longer T-bill, rather than leaving everything in a variable account. Nobody can predict rates perfectly, but knowing which way the wind is blowing helps you choose between flexible and locked. Let's put all three side by side, head to head, because this is the whole decision in one view. High yield savings, around 4%, fully liquid, but the rate can change anytime. Best for money you might need. CD, around 4 to 4.5%, rate locked for the term, but your money is committed. Best for money with a deadline. T-bills, around 3.5 to 4%, backed by the government and free from state tax. Best for maximum safety in high-tax states. All three are federally protected and paying roughly 10 times the national average. The rate is nearly the same. The real question is access, locking in, and taxes. So let's turn this into decisions. Start with the most important pile of cash you have: your emergency fund. Your emergency fund exists for one reason: to be there instantly when life goes wrong. A surprise car repair, a medical bill, a lost job. That money has to be available the moment you need it, with no penalty and no waiting. That points to exactly one answer: a high-yield savings account. It gives you the roughly 4% return and complete any-day access. Never lock your emergency fund in a CD, and never tie it up where a penalty stands between you and your own safety net. Emergency fund equals high-yield savings. That one's simple. Next, money with a job and a date attached. A house down payment you'll need in 18 months. A wedding next year. A tax bill you're saving toward. For money like that, cash you know you won't touch until a specific point, locking in the rate makes sense. This is where a CD or a Treasury bill shines. You pick a term that lines up with your deadline, freeze today's rate, and you're guaranteed that return when the money comes due. The bonus: because it's locked, you're not tempted to spend it early. The small loss of flexibility is exactly the point. Known timeline, money you won't touch. Lock it in with a CD or a T-bill that matures right when you need it, Now a decision that depends on where you live. Cash sitting in a regular taxable account, especially if your state income tax is high. If you're in a no income tax state, a high yield savings account and a T-bill are close to a coin flip on rate. But if you're in a high tax state, California, New York, and others, the T-bill's state tax exemption can tip the scales meaningfully in its favor. Run the tax equivalent yield. Take the T-bill's rate and compare it to what a savings account pays you after your state takes its cut. In a high tax state, the T-bill often wins even at a slightly lower headline rate. High tax state, taxable cash, give T-bills a serious look. Here's a move the pros use to get the best of both worlds, access and locked-in rates at the same time. It's called a ladder. Instead of putting all your money into one CD or one T-bill, you split it across several with staggered maturities. Say you have $12,000. You might buy one that matures in 3 months, one in 6, one in 9, and one in 12. Now something comes due every few months. You get regular access to a chunk of your cash, and each time one matures, you can reinvest it at whatever the current rate is. If rates rise, you catch up. If they fall, most of your money is still locked at the older, higher rate. A ladder turns locked accounts into a flexible, rolling machine. Let's pause on the most important word in this whole video, safe, because all three of these options are about as safe as money gets, and it's worth knowing exactly why. High-yield savings accounts and CDs at a legitimate bank are covered by FDIC insurance, up to $250,000 per person per bank. Since the FDIC was created in 1933, no one has ever lost a penny of insured deposits. Credit unions have the same protection through the NCUA. Treasury bills are backed by the full faith and credit of the United States government, the benchmark the entire financial world calls risk-free. So this isn't a choice between safe and risky. All three are safe. You're just choosing the right tool for the job. So let's make it usable. Here are the DOs, general principles, not personal advice. Do move your idle cash out of any account paying near zero. Leaving savings at the big bank is the one guaranteed way to lose to inflation and miss easy interest. Do match the tool to the job. Emergency fund in high-yield savings, money with a deadline in a CD or T-bill, taxable cash in a high-tax state worth a look at T-bills. Do compare rates after taxes, not before, especially with treasuries. And do confirm any bank is FDIC insured, or the credit union is NCUA insured, before you move a dollar. Now the don'ts, where people slip up. Don't leave your savings at 0.38% or worse, when the same safety pays 4%. That's free money, walked away from. Don't lock money you might need into a CD. An early withdrawal penalty can wipe out the interest you were chasing. Don't chase a flashy teaser rate without reading the terms. Some require huge balances or drop after a few months. And don't forget the tax angle. In a high-tax state, ignoring the T-bill's state tax exemption can quietly cost you the better deal. So here's the bottom line. If your cash is sitting in a big bank account earning almost nothing, you're leaving hundreds, maybe thousands of dollars a year on the table for no reason and no extra risk. The fix is simple, and you have 3 safe, roughly 4% homes to choose from. High-yield savings for money you might need, a CD to lock in the rate on money with a deadline, and treasury bills for maximum safety and a state tax break. It's not about picking the single best one. It's about matching the right tool to each pile of cash you have. Move your money off the sidelines and let it finally start working for you. Let's put it all together. Where to park your cash in 2026 by the numbers. The national average savings rate is 0.38%. The best safe options pay around 4%, roughly 10 times more. High-yield savings, about 4%, fully liquid variable rate. CDs, 4 to 4.5%, locked and fixed. Treasury bills, 3.5 to 4%, the safest of all, and free from state and local tax. All three are federally protected. Emergency fund goes in high-yield savings. Money with a deadline goes in a CD or T-bill. And in a high-tax state, run the tax equivalent yield on T-bills. Same cash, same safety, 10 times the return. Here's the real bottom line. Keeping your money safe and earning a real return are not opposites. In 2026, you can have both. You just have to move your cash off the sidelines and into the right account for the job. At USAFinance, that's the mission. Hand you what you need to get, keep, and grow your money. Sourced and in plain English, never advice. If this earned you a better rate, subscribe. It's free, and it's how we keep going. And next time, we head back into credit and answer one of the most confusing questions there is. Why does your credit score sometimes drop even when you pay every single bill on time? The answer will surprise you. I'm Don Blake. Make your money work. We'll see you next time.